Okay, so before we go any further, you're going to need to know some options trading terminology, which will make it easier for you to follow and understand the rest of the course. We'll be discussing a lot with these terms. I'm going to keep this super basic and just to what you need to know for now. So as always, feel free to rewatch any of the videos in this course so you can keep up and you're not feeling overwhelmed as we progress.
Stock. Once a company is publicly listed on a stock exchange, it becomes a stock that you can invest in. You can buy a fractional ownership of the company. Shares. Every stock is broken up into a finite amount of financial parts, usually in the millions or billions, that you can buy to become a shareholder. These are shares. Brokerage. This is the software platform you will use to buy and sell shares, or in our example, to buy and sell options contracts. Buy. When you make a purchase of an option contract. In order to gain a profit when opening a contract, buying can be known as going long. Sell. When you make a sale of an option contract. In order to gain a profit when opening a contract, selling can be known as going short. Ticker symbol. Instead of saying the entire name of the stock, they are abbreviated for ease of searching. For example, PayPal is abbreviated to PYPL. Open position is a position in a trade you have initiated that is still active and needs some kind of resolution. Closed position is a position in a trade that you have resolved either through buying, selling, or assignment. Assignment is an action taken where the contract seller is now obligated to transact shares of a stock as per the contract agreement. Credit, incoming money. Debit, outgoing money. Premium. Every option contract will have a price that it is worth. This is referred to as premium. Days to expiry, often abbreviated to DTE. This is the time period that the contract lasts for. For example, you can trade a 2-day contract or a 5-day contract, and so forth. Bid-ask spread. When buying a contract, there won't just be a fixed price. There will be a price range. Think of it as haggling to buy or sell something. This is what the bid-ask spread is. Mid-price. This is the price in the middle of the bid-ask spread. Fill price. The price within the bid-ask spread that the option contract is finally transacted at. Buying power is another way to refer to the available capital in your account. Options chain is a list of available contracts on stocks that offer options contracts. This will be in your brokerage and is where you can execute trades on contracts. Strike price is the price level in an option contract that you can choose where you think the stock price will or won't be breached by the contract expiry. Out of the money is if the stock price has currently not breached your strike price. At the money is if the stock price is right on your strike price level. In the money is if the stock price has breached your strike price. Put is one side of the contracts available on an options chain that can result in exercising a requirement of a purchase of shares. Call is the other side of the contracts available on an options chain that can result and exercising a requirement of a sale of shares.
Don't worry if these don't make sense yet. I'll elaborate on this more later. They won't make sense because you haven't put them into context with anything yet. But read over them again and just get familiar with their general uses and descriptions. Once we go further into these lessons and I use them repeatedly in context with references, then you'll start to get the hang of it more. So take some time now to digest our lesson. Have a good day.